Hello, my name is Mark Weaver. Thank you for listening. Let's get creative. There are some creative ways that you can give more than just writing a check. There are alternatives that you can do that can save you tax money and or allow you to magnify your gifts. Just put simply, there's more than one way to give. Oftentimes people just think about their income when it comes to giving to a nonprofit, a charitable cause. Actually, in the United States of America, about 98% of all the assets are in something other than a checking account or money market account. I think it's probably time that we can be creative and find ways to benefit both you and the nonprofits that are important to you. So let's look at a couple examples. You could look at something such as gifting appreciated assets, individual stocks or mutual funds or real estate or exchange traded funds. And that will allow you to avoid capital gains, but you still get an income tax deduction on the value of the gift. Maybe in short, the way this works is you're not receiving the income that you would receive if you were to sell the stock, for an example, and gift it to the nonprofit. Well, how does that work? Well, if you were to sell the asset, you would recognize the income, but when you give it to a nonprofit, they take the asset, they sell it, and since they're a tax-exempt organization, there's no tax owed on that. So you avoid extra income, but you still get the same tax deduction in a sense as you give in cash. And this technique works if you have assets, stocks that you're not needing the income now or in the future on. But you know what? It also works for things like cryptocurrency. Let's look at another creative opportunity that is often missed. If you have an IRA and are 72 years old or older, you're required to take a minimum distribution, also known as an RMD. However, you have an opportunity, instead of taking it directly and recognizing the income, you can transfer it to an operating nonprofit. The beauty of doing that is, just like the previous example, the income does not show up on your tax return. You're not creating additional income. You direct it, it's called a qualified charitable distribution, to the nonprofit. So what that means is you don't recognize the income. It wouldn't cause any additional Social Security income to be taxable had you taken it. It also will not affect your Medicare premiums. It won't put you in a higher tax bracket because you don't even recognize the income. Under current tax laws, an individual filing a tax return gets a $13,000 standard deduction anyway. A couple gets $26,000 of a standard deduction. So just take a couple for an example, $26,000. So if their charitable contributions and other itemized deductions are less than $26,000, they take the standard deduction. Whenever you would take your required minimum distribution directly from your IRA, that sits on top of your income. Even if you give it to the nonprofit at that point in time, if you don't have a total of $26,000 of itemized deductions to go on along with that, you're going to end up having paid tax on money you did not even have to pay tax on. It is a creative way that saves you tax dollars, which can allow you to either have more dollars for whatever you want them for or to give them away. Get creative in your giving. Again, it's possible to decrease your cost of giving or magnify your giving just through tax savings. But always consult your tax professional to make sure that these are right for you. What you may find is there additional things that you could do to continue to be creative with your giving, to leverage what you have been entrusted with. Thank you.